What if I told you there's one account where you can do three things at once? Put money in before the government taxes a single dollar of it. Invest that money and pay zero tax on the growth, and then pull it out, completely tax-free, to pay for medical costs for you or your family. Most accounts give you one of those. A rare few give you two. This one gives you all three. It's called a health savings account, or HSA, and it might be the single best account in America that most people are using completely wrong. By the end of this video, you'll know exactly what an HSA is, who can get one, the rules that make it so powerful, and how to set one up. But stay to the end because the last part, the strategies to squeeze the absolute maximum out of this account, is something almost nobody explains, and it can turn a boring medical account into the most powerful money you own. Let's start with why this account is special. That triple tax break. Let's walk through each one with real numbers. Tax break number one. Your contributions go in before taxes. Every dollar you put into an HSA comes straight off your taxable income. Say you're single, earning about $70,000 a year, so your top dollars are taxed at 22%. If you put in the 2026 maximum of $4,400, that whole amount disappears from your taxable income, and you keep about $968 that would otherwise have gone straight to the government. And to be clear about how this works, contributing lowers your taxable income and saves you your tax rate on the money you put in. It doesn't magically drop your entire income into a lower bracket. It just means the government never taxes those dollars at all. Tax break number two. The growth is tax-free. Any interest, any dividends, any gains inside the HSA, never taxed. To see how big that is, compare it to a regular brokerage account. There, you're investing money you already paid income tax on. And then, when your investments grow and you sell, the government taxes your gains again. The HSA skips both of those. The money goes in untaxed, and it grows untaxed. Tax break number three. The withdrawals are tax-free too. When you take money out to pay for a qualified medical expense for yourself or your family, you pay zero tax on it. Now here's the punchline. Think about the other accounts you know, a 401k or a traditional IRA. You get the tax deduction going in and tax-free growth, but you pay tax when you pull the money out in retirement. A Roth IRA, you pay tax going in, but you get tax-free growth and tax-free withdrawals. Each of those gives you two of the three. The HSA is the only account that gives you all three. That's why people call it the triple tax advantage. So if it's this good, here's the strange part. Why do most people barely benefit from it? Because most people treat their HSA like a checking account. They put money in, and they immediately spend it on this year's doctor visits and prescriptions. And the vast majority never invest a single dollar of it. It just sits there in cash, earning almost nothing. Which means they're throwing away the most powerful part, the tax-free growth. Later in this video, I'll show you the simple fix. And it's the difference between a few $100s and hundreds of thousands. But first, the basics you actually need. Who qualifies for an HSA? The main rule is that you have to be enrolled in what's called a high-deductible health plan, or HDHP. In 2026, that means a plan with a deductible of at least $1,700 for just you, or $3,400 for a family, and out-of-pocket costs capped at $8,500 for you, or $17,000 for a family. A couple other rules. You can't have other non-HDHP coverage on the side, you can't be enrolled in Medicare, and you can't be claimed as a dependent on someone else's taxes. Next, the limits and the rules that make this account quietly powerful. In 2026, you can contribute up to $4,400 if it's just you, or $8,750 for a family. And if you're 55 or older, you can add another $1,000 on top. What counts as a qualified medical expense? A lot. Doctor visits, co-pays, prescriptions, dental, glasses and contacts, and much more. And here are the rules that matter most. First, the money rolls over. This is not one of those use it or lose it accounts. Whatever you don't spend stays yours forever. Second, there are no required minimum distributions. Unlike a traditional 401k or traditional IRA, nobody ever forces you to take the money out, so it can keep growing tax-free for as long as you want. And third, the withdrawal rules. For qualified medical expenses, you can pull money out tax-free, anytime, at any age. Before 65, if you take money out for non-medical reasons, you'll pay a 20% penalty plus income tax. But after 65, that penalty disappears. Non-medical withdrawals are just taxed like a regular retirement account. And hold on to that idea because there's a simple, completely legal way to get money out penalty-free at any age. I'll show you in a moment. One quick note on setting one up. There are two routes. If your employer offers a high-deductible plan with an HSA, you can contribute right from your paycheck. And that route has a bonus. Those contributions also skip payroll taxes, an extra saving you only get by going through your employer. Or, if your employer doesn't offer one, you can open an HSA yourself at most major brokerages and still get the income tax deduction. You just won't get that payroll tax break. Okay. So far, we've kept it simple with one person, but most of us are covering a whole family. So let's make this real. Let's meet 4 households. They all earn the same money, they're all in that same 22% tax bracket, and they all spend about the same on healthcare. The only thing different is what they do with an HSA, and I want you to keep 2 numbers in the back of your mind. The average family spends around $5,000 a year out of pocket on medical costs. And over an adult lifetime, that adds up to roughly $320,000. That money gets spent no matter what. The only question is which dollars you use to pay it. Meet our first household, Joe. Joe doesn't have an HSA at all. He pays that $5,000 a year in medical bills straight out of his paycheck, with money he's already paid taxes on. And that's the hidden cost. To actually have $5,000 left to spend after taxes, Joe had to earn about $6,410 and hand roughly $1,400 to the government first. Joe gets none of the 3 tax breaks. Now meet Sam. Sam has an HSA, but he uses it like a checking account. He puts in $5,000 a year and he pays his medical bills straight from the HSA debit card. He never invests a dollar of it. Now, Sam is doing better than Joe. Because he's paying those bills with pre-tax money, he saves about $1,100 a year. Over 40 years, that's around $44,000 in tax savings. Not bad. But, and this is the mistake we talked about earlier, Sam is only using 2 of the 3 tax breaks. He gets the deduction going in and the tax-free withdrawal coming out, but because he never invests, he throws away the most powerful one, tax-free growth. Sam is what most people are. Now it gets interesting. Meet Priya. Priya maxes out her HSA, the full $8,750 for her family. She still pays her $5,000 in medical bills from the account, but the rest, about $3,750 a year, she invests. Because she's contributing the full amount, she's saving around $1,925 a year in taxes, far more than Sam. And now she's finally using all 3 tax breaks, money in tax-free, growing tax-free, and coming out tax-free. Assuming a 7% return, and returns are never guaranteed, that invested money quietly compounds into a serious tax-free nest egg. And then there's Grace. Grace does something clever. She maxes out her HSA too, but she invests every single dollar of it. She doesn't touch it for medical bills. Instead, she pays those out of pocket with a rewards credit card. And here's the key. She saves every single receipt. Grace gets the same big tax deduction as Priya, but her nest egg ends up meaningfully bigger because she's investing the full $8,750 every year instead of just the leftover. Now you might be thinking, the credit card cashback, that's the trick, right? No. 1% on $5,000 is about $50 a year. That's a rounding error. It's a nice little bonus, but it is not the point. The point is that Grace keeps more money compounding tax-free, and she keeps total control over when she takes it out. Because here's Grace's real superpower. And this is the part almost nobody knows. Those receipts she's been saving, an HSA lets you reimburse yourself for any qualified medical expense from any year, as long as it happened after you opened the account. There's no deadline. None. So Grace could pay a medical bill today, save the receipt, let that money grow inside her HSA for 10, 20 years, and then reimburse herself, tax-free whenever she wants. She's essentially created a tax-free savings account she can tap at any age, penalty-free just by keeping her receipts. The only fine print: the expense has to come after you opened the HSA. You can't have already been reimbursed or deducted it elsewhere, and you can only pull out tax-free up to the total of the receipts you've saved. Keep good records, and it works. But I want to be honest about Grace's strategy because it comes with a real catch. To pull this off, Grace needs the cash flow to do two things at once: put $8,750 into her HSA and to pay her medical bills out of pocket. That's almost $14,000 a year of cash she has to have available. Not everyone can do that, and if you can't, that's completely fine. Priya's approach, where you pay medical bills from the HSA and invest the rest, is the smart, realistic default for most people. Now, let's fast forward because this is where the whole thing pays off. 40 years later, retirement. Here's the thing nobody tells you. Your biggest medical bills don't come during your working years. They come at the end. The average 65-year-old couple retiring today will spend around $345,000 on healthcare over their retirement. $345,000. So think about where our four households stand. Joe and Sam are facing that enormous bill with taxed income and ordinary savings. They never built anything for it. But Priya and Grace, they've each got a tax-free nest egg built over 40 years, ready for exactly this moment. The triple tax break paying off right when healthcare costs hit the hardest. And Grace, who invested the most and saved every receipt, has the biggest, most flexible tax-free reserve of all of them. That's the real lesson here. An HSA is not a medical checking account. Used right, it's the most tax-efficient retirement healthcare fund the tax code allows. 3 tax breaks working together for decades. So quick recap. The HSA is the only account with all 3 tax breaks. The mistake is spending it like a checking account. The win is investing it and letting it grow for the medical costs that hit hardest in retirement. Now, one important note: everything in this video is for education only. It's not financial or tax advice. The rules and the limits change, so talk to a qualified professional about your situation. And I'm genuinely curious, which one are you right now? Are you a Joe, a Sam, a Priya, or a Grace? And more importantly, which one are you going to become? Tell me in the comments. I read them. And if you want more videos that break down money systems like this one, do me a favor and hit like and subscribe. I'll see you in the next one.